we're live. Some technical difficulties. Welcoming 2023.
Happy New Year.
Happy New Year, Jeff. It's great to have you back again. Last year was super fun doing this, so I think we've decided we'll just continue to inspire and educate.
That's the goal for sure. Yeah, it was a fun. I think we did it probably 6 months in a row, which was nice. 5-6 months. Yeah, keep it up.
Cool. So there's some new rules. There's some new things in play now with the foreign buyer ban. There's actually, yeah. So do you want to maybe give us some insight on this? Because I even don't really know a whole lot about it myself yet.
Yeah. So as of January 1st, their government has implemented a rule that says, I'll break it down in very simple terms. Anybody who is not a permanent resident, a temporary resident, or has a Canadian citizenship cannot buy a residential property in Canada for a minimum of 2 years. So their idea was, hey, let's help the let's help Canadians out by banning foreign buyers, and hopefully that means a bit of less competition. More opportunities for buyers, for Canadian buyers to get into the market. That's kind of everything in a nutshell.
Yeah.
There are a lot of exceptions, though.
That was my next question.
There are a ton of exceptions. So some very simple ones, or some ones that really stood out to me, were one, it's only for residential properties. So they can still buy commercial, like multi-unit properties.
Okay.
No ban on that. If a foreign buyer wants to purchase in a town of less than 10,000 people, they can do that. No problem. And the biggest one, the most surprising one for me, is they're actually able to purchase secondary property and like cottage or vacation home.
So it's just not a primary residential home.
Correct. They can't purchase like a primary residential home, but the thing issue is that foreign buyers typically will never purchase a primary residence in Toronto or in the GTA in Canada. They're not going to live here the majority of the time if they live outside of Canada. So this is causing a lot of confusion. There will be more rules and regulations around this specific new guideline, but we don't know all the details yet, and it's January 4th, so more to come on that. But yeah, so to break it down, one, foreign buyers are not allowed to purchase residential properties in Canada for a minimum of 2 years, with a couple exceptions.
Yeah, so the exception almost like, unless they really, really want to live here permanently, kind of defeats the whole purpose.
Yeah, so like buying cottages, buying properties that I think the real reason why the government did this is that they don't want foreign buyers to purchase a property in a city and just rent it out. Like that's what they're trying to avoid. They don't want people, or just leaving it vacant either. That's what they don't want. So these exceptions are all a bit wonky, and we'll learn more about that as the weeks and months go on. But the news headline is no foreign buyers for 2 years. So,
all right. Well, that's good information, because I know that with that talk of it happening January 1st, I know there was a bit of an influx of transactions, foreign buyers doing their transaction prior to
December 28th. We had one. Yeah.
Yeah.
Yeah. 100%. So as long as the property was purchased, you have that sale agreement before January 1st, you were fine.
Okay.
Yeah.
Very good. We were going to maybe chat too about qualifying for a mortgage now. I'm on my phone because of our technical issue, so my note on my phone. So we were going to talk about, qualifying for a mortgage and remortgaging, right?
Yeah. So I've had a lot of clients who are, for buyers, for one, kind of two categories. Buyers are having a tough time qualifying for properties. This time last year, you could take a household income before taxes, multiply it by around 5, maybe 5 and a bit, and that's kind of that maximum mortgage amount that you'd be able to carry. Then you add your down payment on top of that, and you're good. So a quick example, If as a household you made $100,000 a year ago, you could qualify for $500,000 mortgage and then add your down payment on top of that, as a very quick example. Now, you take that same family that makes $100,000 household income, and we can multiply their total amount by like just over 4. So they're qualifying for about $100,000 less, which is probably why we're seeing a lot of house prices decrease as well, because people can't afford what they could a year ago. So
Yes.
it's been like a very monumental year, not in a good way for buyers, or monumental 2022. So everyone's very intrigued to see what this new year will bring.
Yeah, and with interest rates, what are your thoughts on that? Like, do you think that they're going to continue to increase, or do you think they're going to slow down a little bit? Or
I think both. So I think on the 26th, I believe it is this in January, I think they're going to increase again. One, maybe 2 more times this year. This is my prediction show, I guess. And then hold steady for the rest of the year. Probably no increases, no more decreases, as long as nothing big changes in the world. No like huge whatever. Yeah, exactly. As long as the pandemic stays relatively the way it is. Yeah, that's what I think. Probably 1, maybe 2 more increases, and then it will hold steady. For the first time in a long time, variable rates are more expensive than a fixed rate. There are tons of pros to variable rates outside of the rate itself. But just from if you're looking at the numbers, it's more expensive right now to have a variable rate than it is fixed, which was not the case for the past 5 years.
I'm so glad we didn't do a variable rate back in, like, I think it was March. We were going to do a variable, like we were going to break our mortgage and do a variable. I'm so glad we didn't.
It was so enticing though, like it was because they were so much cheaper, and there's tons of different options with that. The way I like to explain it to clients is, if monthly payment is like the be all end all, then hey, a fixed payment's probably the way to go.
Right.
If you have some flexibility, if you probably are going to pay, you're probably going to pay the least amount of interest over the term of your mortgage with a variable rate. But if it's all about that household income, if it's all about that monthly expense, like this year has shown a lot of people how scary certain products can be.
Yeah, for sure. Now, is the stress test still in effect with all of this?
Yeah, so that's what's really hurting our qualifying. The regulators just came out and said it's not going to be any change to the stress test. So the way it is, the way we qualify borrowers or clients is if you take whatever the interest rate is. So if the interest rate is 5%, we have to qualify your interest rate plus 2%. So we're qualifying at 7%. So now if we're qualifying at a fixed rate of 5% or a variable rate at 6%, really huge difference in the qualifying aspect of things.
For sure.
So I'm noticing right now a lot of clients are like kind of taking or ideal, or in their mind they want to take a fixed rate because they can qualify for more money that way. It's always it's a give and take. It's a conversation because interest rates haven't been this high in now 15 years, since 2008.
Right.
So if it's like me today, I personally would not want to lock in on a 5-year term when rates are the highest they've been in 15 years. Right,
because there's a good chance of them coming down, right?
And we've seen them come down. So over the past month, they've come down actually pretty substantially. They've come from like 5.5 closer to like 5.1, which is nice. It's like a big drop that you don't hear about in the news. But a nice drop and a lot of savings for clients who maybe purchase, who are closing today or tomorrow or next week. And we can do what's called like a float down, which means if you get approved on a certain fixed rate, and a couple days before closing, if rates are lower than they were what you were approved with, we'll get that lower rate.
Oh, okay, that's really good. And it doesn't work the opposite way, right?
If rates are higher at the time when you close, you're happy that you locked in that lower rate. So no, it doesn't work out. Yeah.
That is good. That is good.
Yeah.
So for people what is going to happen this year for people who are renewing their mortgages?
Great question. It's going to depend. So if people are renewing their mortgage in 2023, it means that they likely got their mortgage in 2018. So it's going to be harder. It's going to be hard to qualify. But the good news is that throughout those 5 years, people have paid down their mortgage quite a bit. ideally they would have paid down their mortgage quite a bit. So let's say you had a $400,000 mortgage 5 years ago. Hopefully that mortgage is at like 320 right now. It depends on your interest rate. Let's say 320,000. So
Right.
then you actually only have to qualify on that $320,000 now, which shouldn't be a big issue. The other thing is that over the course of 5 years, expectation is, the hope is that maybe people did get that nice promotion or some sort of raise or move jobs to get a bit of a higher salary, which will also help in qualifying.
Right.
For those people who have not gotten that, or maybe some life changes have happened, it's going to be challenging to qualify. So what the conversations I have with a lot of clients is, one, most lenders will offer you just like they'll give you a call 3 or 4 months prior to your renewal and say, hey, sign this piece of paper. We don't have to look at any documents, which is great for some people because if their situation have changed, it's like it's a breeze.
Yeah.
The downside to that is you're subject to kind of, whatever interest rate they offer you is the interest rate you're going to get. Probably, it's definitely not the best interest rate on the market, but at least it's pain-free and no documents are needed. It saves you probably an hour of work. But yeah, so that's kind of the downside to that.
So if personal circumstances change in regards to like they've changed jobs or maybe they're single now instead of married or common law, that kind of thing, like it's kind of like your pass-go free,
That's it. Yeah, exactly. Or if they've taken on some additional debt and are a bit worried about that, or bought a car that's just a bit more expensive than it was a few years ago, all of that's going to impact with these rising interest rates.
Mm-hmm.
So again, what I would recommend is, one, I would never just sign that piece of paper that the bank or the lender sends you. Always explore what those options are for you. It might be the best option, but we don't know until we actually do the homework.
Right. For sure. And that's why they need to hire somebody like yourself who can actually just be transparent and say, look, you're not going to get the best interest rate, but for your personal situation, if this were me, because I know a lot of my clients will, like, we're showing houses or we're putting in offers. They're like, okay, if this was you, what would you do? Yeah. That is like, if I had a $5 bill for every time I was asked that question.
It's a good question though. I get that asked too. Like, hey, if you were advising your brother, your sister, your parent, like, what would you advise them?
Yeah, exactly.
The great thing about like renewals and stuff is we can have like a 10-minute conversation and find out in those 10 minutes if the rate that the lender's offering you is the best one, or if it's worthwhile to explore other options. We don't have to look at everything in the world. We can do this pretty quickly, especially for a renewal, which is nice.
Now for appraisals, so say they are taking the free pass and not, having to do anything other than accept what the bank is offering. Is there an appraisal necessary for that, or is that only if, or is there an appraisal necessary for any renewal?
I would say it depends. Like, it's a great question. Like if someone did a 5-year term, I've never been asked to get an appraisal done for a transfer to a new lender or even a renewal with the same lender, because the assumption is the property value is increased.
Right.
We are, there's a bunch of headlines in the news around or on social media around housing prices dropped 20%, but that's kind of from like pandemic prices. So if you're going to look at prices from 2018, we're still up.
Exactly. Yeah.
Which is why most lenders, there are some creative ways around getting an appraisal waived. And I haven't been asked for one yet.
Right. Now, so say somebody is in a renewal position or situation and they've accumulated debt over the last 5 years, remortgaging with additional to pay off their debt. What does that situation look like?
Yeah, that's like been probably the most common scenario I had in the month of December. You are on it. You should be a part mortgage broker.
Well, I get all these questions, right? And I'm like, I don't know the answer.
Yeah.
Go talk to Jeff. Go talk to whoever, right?
Yeah. that's been like one of the most popular situations that we've seen where people, yeah, they're up for renewal, but they have a lot of debt to pay off, or they're just, they just accumulated stuff over the course of the last however many years. So we do like a full-on refinance and debt consolidation. So essentially what we do is pull all the debt, add it to your mortgage, and at the time of renewal, we just lump it all together. There's no penalty to pay, nothing like that, which is great. Right. And then all of your high interest debt, like credit card debt, even some car payments people have done because rates are a bit higher right now for that. Lines of credit, all that will be all put into one mortgage. Mortgage is typically at the lowest interest rate that we'll find.
Right.
And everything's just under one payment, and they're free and clear from all their debt.
Best decision to probably pursue now.
It's the best decision for almost everyone. Unless they have an amazing line of credit. That like there are certain situations.
I almost have perfect credit and like 846 or something.
Oh yeah.
And like my line of credit is like 12% or something.
Yeah.
Like it's so high. I thought they were supposed to be like 6 and 8%.
That would be nice. Yeah, like the different kind of lines of credit. If it's secured against your property, you're probably looking at prime plus 2, maybe. It depends. So prime right now is at 645, so it should be at like 845-ish. But if it's an unsecured line of credit, so if it's just like you can walk into a bank and they take your income, it's going to be prime plus quite a bit. So I'm not surprised at 10 or 12%. Yeah.
And so for example, I just want to give like a personal example. So we've talked about this before, where in 2020 we locked into this house at 1.84. So we've accumulated debt. We have we purchased a trailer, like a camping trailer. It's more of like a house kind of that's permanent. So say we want to remortgage and take all that debt and put it in. The thing that scares me is like I will never ever be able to lock in at 1.84 ever again. And does the math actually work, like to actually benefit us in the long run? So like you would do something where you would actually like evaluate the whole situation, right?
Oh, I'm like a huge spreadsheet nerd. I love it. So
they make me want to puke.
Yeah, fair enough. We run a bunch of different analyses and just to see what actually makes sense. I'll tell you this, like the people who did get under 2% fixed rate, it is absolutely incredible. And like you said, we'll never get it again.
Yeah.
Also, those, you're kind of stuck, right? Like you're so happy, and it will never really make sense probably to refinance. And be subject to whatever the current interest rate
not
is.
until 2025 at least.
Yeah, exactly. Not until 2025. So probably like that rate is just so phenomenal. And now whereas now rates are like 3% higher than that, it's like 2 times higher or 3
so
times.
What I would be paying extra in the the mortgage payment is probably more than what my individual monthly payments are.
For sure.
Right.
Yeah. And the other thing to note too is like there are other creative solutions for situations like that. Whereas, hey, maybe you want to keep your current mortgage the way it is, but maybe it makes sense depending on the interest rate you're paying for the trailer. Maybe it makes sense to get, like, I know second mortgage sounds so scary to a lot of people, but maybe it makes sense to get like a second mortgage or a secured line of credit where the interest rate's a lot lower.
Right.
There are solutions. There's always a different solution to the problem. It just depends on what makes sense for you.
Right. No, that's what I love about mortgage brokers is, people who are honest, obviously, are the ones that you want to work with because they, I think someone like yourself, you really have, the long term in mind of, seeing this client as a lifetime client and doing what's best for them, not for you, and be very client focused. And it makes the client feel so much better knowing that you're not just telling me to get a second mortgage because you're just going to get X amount of commission or whatever, right? Like you're doing it because genuinely if this were you in this situation, this is what you would do. And that's what I love.
I think it's in my mind it makes sense, and it's an ongoing way of like it's an ongoing conversation with myself and how I can best educate other people. Whereas like, a lot of people accumulate credit card debt, and credit card debt's all at 20%, which is it's a lot of money. So sometimes when you bring up the word like a second mortgage or a line of credit at 5, 6, 7, 8%, it's just the word like second mortgage or line of credit has like a negative connotation to it for some people. But when this is why I love spreadsheets, because numbers can't lie.
Right.
So when you take that 20% interest on a credit card and go that over the next year versus the cost of setting up and opening up a line of credit, and the numbers don't lie. So it's not as much me telling you, like, hey, here's this information. You got to make the right decision for you and the family. Right.
For sure. Yeah, no, I think that's a really great way to approach your business.
Yeah.
I don't think everybody does it that way, but I'm grateful to be connected with you, because you are super genuine and just down to earth, easy. You can explain things so easily, whereas some people use terminology and it's just like, I don't know what you're talking about.
Yeah, I like to just talk to clients like I'm talking to family or friends. Don't need to go like this, like the type of clothes I wear most of the time. It's not this it's just we're having a conversation, trying to educate.
Yeah, exactly. I would show you my shoes right now. I'm wearing flip-flops.
There we go.
With socks in my basement.
Yeah. That's all you need. That's all you need.
Dress to impress, right?
Yeah, exactly.
Well, is there anything else that you think is notable at this point in 2023 that we should be either focused on or be weary of? Like, is there anything that the consumer needs to know, or?
I would say just if you're in the market to buy, I think over the next 4 months, we're going to continue to see fixed interest rates decrease bit by bit, which is always nice. Pre-approvals are probably more important now than they've been in the past 3-4 years.
Okay.
With the increase in interest rates. So the best part about a pre-approval, one, saves the client time, 2, saves your the realtor's time, 3, saves mortgage brokers time, saves lawyer, everyone. And the other great thing about them is that we have the opportunity to lock in an interest rate, and whether or not that's the best interest rate at the time that you buy doesn't matter. At least we have something locked in to base our budget off of, and it's kind of like I like to think of pre-approval rates as kind of like a worst case scenario. Hey, worst case, this is what we're going to be paying on a monthly basis. And if we get better than that, fantastic. But this is like the worst case scenario. And it's just nice to plan. A lot of people in the new year, I got a lot of emails on January 1st with, hey, I want to buy. Hey, I'm looking to consolidate debt. Hey, my mortgage is coming up for renewal. This new year brings on like these
new challenges.
New challenges. There we go. So just the only thing I would say is just be open to options, be open to creative solutions, because that's what we're probably going to look at for the next couple of years.
Last question, and I'm trying to think as a buyer. Okay, so I want to buy a house this year. I don't know, when the right property is going to come up. So I get pre-approved right now, and I lock in and for 60 or however many days it is that you can lock in. Is it going to hurt me from a credit standpoint if I don't find anything in that time frame and then I get pre-approved or
yeah, that's a great question. So if you have a credit score, let's use your example of like 800 or whatever it is. If I pull your credit, Equifax, these places won't give you exact numbers, but from what I've seen, if we have if we have a score of 800 and I pull your credit today, maybe it drops it to 796, something like that. Right. By the time you make your next bill payment, you're probably up to like 800 or 801 again.
Right.
If we continuously pull it over the next year, we're pulling it every 4 months, it's going to have that same effect. If I'm pulling it, another mortgage broker is pulling it, the bank's pulling it every 4 months, that's when it really compounds and has like a much bigger
negative effect. Yeah.
Yeah. But the thing to note too is that like pulling of credit or checking credit accounts for only 10% of your total score. So, it's not really going to hurt you too much.
Right.
Okay. The thing that will hurt is if you don't pay your bills on time, or just like the credit utilization and the number of line of credit that you have. So making sure you have at least one credit card, at least one line of, or 2 trade lines, they say. So like 2 credit cards, or 1 line of credit and 1 credit card, and you're utilizing those up to a maximum of like 30% of that total limit every month or so.
Right. Okay.
Those are the biggest things. Yeah.
For sure. Well, it was great talking to you. I look forward to our conversation next month. And it's always exciting to see it's amazing how many changes happen in a month.
I don't think we've spoken about the same thing twice yet, which is pretty amazing. I
always talk about my interest rate because I'm so afraid of what's going to happen when I never, when it expires, and I'm never going to see that number again.
Yeah. Oh, I hear you. Yeah. That's a common trend for sure.
Anyways. All right, Jeff. Well, we will talk to you in a few weeks.
Awesome. Take care, Michelle.
Okay, you too. Bye-bye.